Paresh Sitnankar, ED at HDFC Bank, joins us on the show. Paresh, hi, morning. You have hiked your lending rates recently. What prompted you to do this, and how much pressure are you seeing on your cost of funds because of this move?
Well, I presume you're referring to the change in the base rate. And as you're aware, each bank has a base rate formula, which essentially incorporates deposit rates, the reserve requirements, and policy rates, and so on. And if you go back in the last few months, we were probably one of the few banks which had dropped our base rate from 9.8 to 9.7, and then from 9.7 to 9.6 between the December quarter and the March quarter. And more recently, with deposit rates having gone up, just feeding in those revised deposit rates resulted in the increase at 9.8%. Even with that increase, of course, at 9.8, I think our base rate is amongst the lowest that you have amongst any of the large banks. So really, the base rate changes just reflect changes in deposit rates in the recent past.
Morning, Paresh. Nikunj Dalmia also joining in. So give us an overview of your deposit rates as well. Is there any need to hike them further if the current RBI measures continue beyond 2 months?
Well, actually, if you look at the one-year deposit rates or rates for tenors beyond that, those have really remained largely unchanged. It's at the shorter end where deposit rates, have moved up to 8 or just above 8%, 8 quarter and 8.5 and so on, really reflecting where short-term rates are, in the money markets. Clearly, I don't think at this point of time there is any further upward pressure on rates, but really depends on how the liquidity situation pans out over the next couple of weeks. At this point of time, deposit flow is comfortable at these rates, and I think we are pretty well positioned in that respect.
So how will this rate hike impact your margins, and going forward, what's the outlook as well?
Well, the deposit rates have gone up just literally, last week. But clearly incremental deposits will therefore flow in at those rates. Likewise, on the lending side, apart from the base rate changes, at the shorter end, corporate loan yields have gone up, again reflecting what's happened in the commercial paper market and in the bond markets. So I think broadly, margins will remain in the range that we've seen in the past. You're probably aware, if you look at the last several years, our margins have remained in a fairly tight range. And I think even now our margins will remain in that 4.2 to 4.5 range that we've seen in the recent past.
Paresh, so how long do you expect the RBI measures to stay in force, and is this primarily because of liquidity tightness that you have hiked rates?
Well, there's been really no time frame that has been sort of put in place, by RBI in terms of the measures. I think everyone is clear that these will remain as long as necessary to sort of reduce or till the rupee stabilizes, or at least till the currency volatility ebbs a little. So just going by the past experiences for a couple of times when such measures have been taken, I think it tends to take at least 60 to 90 days or just over that. But at this point of time, it's tough to speculate on how long this will last. Unlikely to be much shorter than that, though.
So are you seeing any growth in credit demand, and will it be right to say that absence of credit demand has prevented the liquidity situation from getting worse?
Well, I think the demand from the credit point of view has clearly reflected what's happening to GDP growth. To the extent that the expectations or the projections of GDP growth this year have moderated from what was somewhere between 5.5% and 6% at the beginning of the year to perhaps somewhere between 5 and 5.5% at best right now. Loan growth has also moderated in the system. And to the extent that loan growth has come off, the pressure on liquidity or pressure on deposit growth has also come off a little. So at this point of time, if you look at the last numbers that have been flowing out, deposit growth and loan growth have been roughly, and this is at an industry level, have been roughly in the 13-14% range. So clearly to that extent, perhaps the liquidity pressures have been that much lower than what they could have been had loan growth been at 15 or 16%.
Are there any concerns on your asset quality given the current slump in the economic growth and tightening rates?
Well, if you look at the banking system in the last year, NPLs have increased by somewhere close to 1.5%, and restructured loans have increased by approximately 2% in the banking system. We have, in the last year, which is June over June, seen roughly an increase of a little less than 10 basis points in gross NPLs. And I guess it's only natural that if the economy has, come off by 2 or 3% in terms of GDP growth rates in the last couple of years, some of those pressures will reflect in asset quality. Having said that, I think, if we believe that GDP growth has sort of bottomed out and is likely to roughly stabilize here before there is any sort of a pickup, I think, you won't see pressures significantly aggravating from here. But at the margin, some increase in NPLs, I think, is realistic just given the economic environment.
Paresh, first quarter saw bank books, seeing some handsome treasury gains. But going by the way the bond yields are playing out, are you anticipating mark-to-market hits on your bond portfolio?
I guess, with yields going up in this quarter, clearly vis-a-vis where yields were at the end of June, depending on where yields ultimately stabilize as of 30th of September, you would have some mark-to-market. But exactly, what extent that would be would really depend on what are both short-term bond yields or short-term T-bill, interest rates in the market, as well as what is happening to bond yields at the longer end. But this is really what is relevant really is what will happen by the end of September.
Okay, Paresh, we leave it there. Thank you for joining us.